Something happened this week that almost nobody in mainstream financial media is talking about. Not on CNBC, not on Bloomberg, not in the Wall Street Journal. And I want you to really stop what you are doing right now because I have been studying financial history, market cycles, and economic collapses for a long time. And I have learned one thing that most people never figure out until it is too late. The most dangerous moments in market history are never the ones that feel dangerous. They're never the ones where the news anchors are screaming about crashes and everybody already knows something is wrong. The truly dangerous moments are the quiet ones, the ones where the surface looks calm, where the anchors on television are still talking about resilience and buying opportunities and long-term fundamentals. And meanwhile, underneath all of that noise, something is cracking, something is moving, something is shifting. And the people who know what that signal means are quietly repositioning right now. They're not talking about it on television. They're not writing op-eds about it. They're just moving their money. And if you have money in the market today, whether it is in a retirement account, a brokerage account, a savings account, or even just a job that depends on a functioning economy, what I am about to walk you through in the next 30 minutes may genuinely be the most important financial briefing you hear this entire month. Let me start with a single number, because in my experience, when you want to understand what is actually happening inside a financial system, you do not start with the stock market. The stock market is the last place to know. It is a lagging indicator. It is the last one to react. Think of the stock market like the way water looks on the surface of the ocean just before an earthquake hits underneath. It looks completely normal right up until it doesn't. The signal I want to show you today does not come from the stock market. It comes from something much older, much deeper, and historically far more accurate. It comes from the credit market, and specifically from something called the high-yield credit spread. And what it has just done in the last 10 days is something that has only happened a handful of times in the last 25 years. Every single one of those times, a major market event followed. So let me explain what a credit spread is, because I think this is where most financial commentary fails ordinary people. They either talk to you like you already know everything, or they drown you in jargon. Do you want to explain this like I am talking to a person who is smart, who pays attention to the world, but who did not spend their career on Wall Street? Credit spread is simply the difference in interest rates between a safe bond, like a U.S. Treasury bond, which is backed by the government, and a risky bond, like a junk bond issued by a company that might not be able to pay it back. When times are good and investors feel confident, that gap between the safe bond and the risky bond stays narrow. Those are willing to accept a lower premium for taking extra risk because they believe things are fine. But when investors start getting nervous, when they start sensing that something is wrong, even before they can fully articulate what it is, they start demanding higher and higher returns to hold risky debt. And that gap, that spread, starts to widen. That widening is the signal. That is the alarm. And the reason credit spreads matter so much is because bond traders are, historically speaking, the smartest money in the room. Stock traders are often driven by emotion, by headlines, by momentum, by fear of missing out. Bond traders are driven by cold, hard math. They're calculating default probabilities, cash flow projections, macroeconomic trajectories. When bond traders start to worry, you should start to worry because they almost always see it before everyone else does. Now here is what just happened. According to data tracked by the Kobasi letter, tech high-yield credit spreads have just jumped to 556 basis points. We put that in context for you. That is above the April 2025 highs, and it is the widest level we have seen since October 2023. Broader high-yield spreads right now are sitting at 361 basis points, the highest since November 2025. And here is the part that should make you sit up straight. Tech junk bonds are now trading at a 95 basis point premium above the rest of the market, which is the highest gap in at least 3 years. Two people who track this for a living are saying the same thing out loud. The credit market sell-off may just be getting started. And if the credit market is cracking, history tells us very clearly what happens next to everything else, to stocks, to housing, to jobs, to your grocery bill, to the purchasing power sitting in your savings account right now. But the credit spread story is just one layer of this, because if you pull back and look at the full picture, what you see is not one alarm bell. What you see is a room full of alarm bells, and they are all going off at the same time. And most people are somehow still sleeping through it. So let me walk you through each one, because when you see how they connect, it changes how you understand everything you are watching in the financial news right now. The first thing you need to understand is where the stock market actually stands as of this week. The S&P 500 is down roughly 7% year to date. The Dow Jones Industrial Average has slipped about 8%. In the NASDAQ Composite, the technology-heavy index that has been the engine of American wealth creation for the past decade, has fallen more than 10%. It is officially in correction territory, and this is happening after the S&P 500 entered 2026 at what the Nobel Prize-winning economist Robert Shiller's research says was the second most expensive stock market valuation in 155 years of recorded data. Let me say that again. The second most expensive in 155 years. The only time it was more expensive was during the dot-com bubble. And historically, every single time the Shiller price-to-earnings ratio, which they call the CAPE ratio, has exceeded the level we entered 2026 at, the S&P 500 has declined by at least 20%. Every single time. This is not speculation. This is the data. And now this week, Barkart, the financial technology company, just flags something specific that you need to understand. The S&P 500 has just closed below its 20-week moving average for 4 consecutive weeks. Now, I know that sounds technical, so let me explain why it matters. Since 2018, every single time the S&P 500 has done this, meaning closed below its 20-week moving average for 4 straight weeks, it has been followed by additional downside every single time. That is 7 occurrences. 7 out of 7. 100%, not 90%, not most of the time, every single time. And we have just hit that mark again right now this week in the first week of April 2026. But the signal I want to spend real time on, because I think it is the most important and the least understood by ordinary investors, is what Moody's, one of the world's most respected credit rating agencies, just quietly disclosed. Moody's has an artificial intelligence-driven recession model. It is not some internet predictor or financial influencer making guesses. It is a sophisticated machine learning model built by professional economists trained on 80 years of historical data. Moody's chief economist Mark Zandi just revealed that this model has reached a 49% probability of a U.S. recession occurring within the next 12 months. 49%? And here is what makes that number so frightening. Historically, every single time this model has crossed the 50% threshold, a recession is followed within a year. Not sometimes, every time. Without exception, back-tested over 80 years of data. And we are sitting right now at 49, 1 percentage point away from a signal that has never been wrong. But here is what makes this even more alarming. That 49% reading was calculated using February data, before the US-Iran war began in earnest, and before that conflict effectively shut down 20% of the world's crude oil supply, before Brent crude climbed above $112 per barrel, before the Strait of Hormuz became a contested waterway, before the OECD revised its United States inflation forecast from 8% to 2% for this year, to 49% was calculated with none of that information factored in, and Zandi himself said it clearly. He said, and I am paraphrasing here because I want to be accurate, that it is not a stretch to expect this indicator to cross the key 50% threshold amid the Iranian conflict and the resulting surge in oil prices. He then said something that I want you to really hear. He said that if oil prices remain elevated for much longer, weeks, not months, a recession will be difficult to avoid. Weeks, not months. He said weeks. Now let me connect this to history, because history is the closest thing we have to a playbook, and you need to understand what this pattern has looked like before. Every U.S. recession since World War II, with the single exception of the COVID-19 pandemic, was preceded by a spike in oil prices. Every single one. The 1973 recession came after the Arab oil embargo quadrupled oil prices and removed about 5 million barrels per day from global supply. The stock market fell 48% from peak to trough. Inflation hit 12%. Unemployment doubled. It took nearly a decade to fully recover. The 1979 recession came after the Iranian Revolution disrupted about 9 million barrels per day. The 1990 recession came after Iraq's invasion of Kuwait spiked prices by 80% in 4 months. 2008 recession was accelerated by oil hitting $147 per barrel in July of that year, crushing consumer spending power right at the moment when the financial system was already cracking. In each case, the oil shock did not cause the recession by itself. It was the accelerant. It was the thing that pushed a fragile system over the edge when it was already under stress. And I want you to think about what kind of stress the system is under right now, because this is where the hidden signal becomes almost impossible to ignore. The U.S. shed 92,000 jobs last month against an expectation of a 59,000 gain. That is not a miss. That is a reversal. GDP was revised down from 4% to 0. 7%. National debt has crossed $39 trillion and is growing at more than $7 billion per day. $9 trillion in Treasury debt is being refinanced this year at rates 4 to 6 times higher than when that debt was originally borrowed. Interest payments on the national debt now exceed $1 trillion annually, which for perspective is more than the entire defense budget of the United States. And on top of all of that, Goldman Sachs strategists have quietly warned that severe disruptions to global oil supplies could drag the S&P 500 down to 5,400 to represent a 22% decline from its January peak, which is by definition a bear market. Goldman Sachs, not some internet blogger. Goldman Sachs. So now let me bring in what happened 1 year ago today, because I think this context is crucial and almost nobody in the financial media is connecting these dots right now. Exactly 1 year ago, on April 2nd, 2025, President Trump announced what he called Liberation Day, a sweeping set of reciprocal tariffs that hit virtually every major trading partner the United States has. The announcement triggered what became the largest global market decline since the 2020 COVID crash. The S&P 500 plunged nearly 5% on April 3rd, then dropped another 6% the following day when China retaliated. In less than 3 days, the stock market lost more than 10% of its value. Apple, Alphabet, Microsoft, Amazon, Meta, Tesla, and Nvidia collectively lost over $1 trillion in market capitalization in a single trading session. $1 trillion vanished in one day. And the reason I am bringing this up right now is not to relitigate history. It is because we are sitting here today in almost exactly the same position. The foundations underneath the market are measurably weaker, and the pressures are substantially larger than that 1% gap between where Moody's recession model sits today and the threshold that has never been wrong is not a theoretical abstraction. It is a live countdown. Now I want to talk about something that the financial media keeps treating as a separate story, but which is actually the same story. And that is the Iran war and what it is doing to the global energy system. Because if you do not understand the energy picture, you cannot fully understand the market picture. Do they give you the numbers that most broadcasts are not connecting to your portfolio? When the conflict in Iran began in earnest, Brent crude was trading around $81 per barrel. It has since climbed above $112. That is a 38% increase. In Morgan Stanley research, I have reviewed estimates that for every $10 increase in oil prices sustained over a full year, it reduces US GDP growth by approximately 2% and adds about 3% to consumer price inflation. With oil up roughly $30 from pre-conflict levels, we are looking at roughly 0.6% less economic growth and nearly 1% more inflation from this one factor alone. These are not projections. These are the mechanical transmission effects of energy price increases through a modern economy. They are already showing up in the data right now. And before you think this is purely a geopolitical story that will resolve itself quickly, I want you to understand something about the structural nature of what has happened. The Strait of Hormuz, the narrow waterway through which roughly 20% of the world's daily oil supply normally passes, has seen traffic fall dramatically since hostilities intensified. The region around that strait accounts for roughly 45% of global sulfur supply, which is essential for fertilizer production. Fertilizer prices are projected to double from 2024 levels. Phosphate prices could increase by approximately 50%. And this is happening during the Northern Hemisphere's spring planting season. Agricultural analysts are already warning that decreased fertilizer availability could reduce yields for wheat, rice, and maize, the three crops that feed more of humanity than any others. The United Nations World Food Program has described what is happening right now as a long-term driver of global food price increases. This is not just an oil story, this is a food story. This is a technology supply chain story because the region also supplies helium that is critical for semiconductor manufacturing. It is a global inflation story and an American household budget story, all converging at the same time. And all of it flows through the same set of market signals that are flashing right now. Let me talk about what the Federal Reserve can and cannot do about this, because I think this is where most people have a fundamental misunderstanding of the situation. The common assumption is that when markets fall, the Fed cuts rates, and that rescues the market. That was true in 2020. It was true in 2008. It was true in 2018. The playbook only works when the problem is deflation, when the problem is falling demand, when the problem is too little money moving through the economy. The playbook completely breaks down when the problem is inflation driven by an energy shock. And that is exactly the situation the Fed is in right now. The Fed's primary mandate, written into the law that created it, is price stability. When inflation is running hot, the Fed is legally and institutionally required to fight it. And you cannot fight inflation by cutting interest rates. You fight it by raising them or at minimum keeping them high. But raising rates in the middle of a stock market that is already down 7% year to date, with a recession model sitting at 49% probability, with credit spreads widening at their fastest pace in years, with a government that needs to finance a war and refinance $9 trillion in debt, that is the definition of being trapped. The Fed is trapped, and markets know it. Traders who came into 2026 expecting several rate cuts are now pricing in at best one cut for the entire year. Some analysts are beginning to openly discuss the possibility of rate hikes if inflation surges past 4%. The rate hike in these conditions would be, and I am not using this word lightly, unprecedented in modern monetary history. This is what economists call stagflation. And if you are under 40 years old, you have never lived through a genuine stagflationary environment because the last time it happened was the 1970s. Rising prices, slowing growth, rising unemployment, all at the same time, all feeding on each other. And the reason it is so difficult to escape from is that the traditional tools for fighting each individual problem make the other problems worse. You raise rates to fight inflation, and you make the recession deeper. You cut rates to stimulate growth, and you make inflation worse. You let the deficit expand to fund stimulus, and you undermine confidence in the currency. There is no clean exit. There is only the question of which pain you choose to absorb first, and for how long, and who ends up bearing the most of it. And if you look honestly at every stagflationary episode in modern history, the people who bore the most of it were not the wealthy, who had assets that eventually recovered. They were the middle class and the working class, who had wages that did not keep up with inflation, savings that were eroded, and debt that became harder to service at higher rates. Now, I want to tell you something that the financial industry does not want you to think too hard about. To put option open interest on major U.S. credit ETFs has just reached a record high of 11. 5 million contracts. This includes the 4 largest high-yield and investment-grade bond ETFs in the United States. Total outstanding contracts have doubled over the past 12 months, and this current level exceeds the 10 million contracts recorded during the 2022 bear market. What this means in plain language is that sophisticated institutional investors are buying insurance against a credit market crash at the fastest pace ever recorded. They're not talking about it loudly. They are not making YouTube videos about it. They are quietly, systematically, and at record scale, protecting themselves against exactly the scenario I am describing to you right now. When the smart money is buying that much insurance, it means they believe the risk is real. You do not spend that kind of money hedging against a risk you do not think is likely. You spend it when you genuinely believe something bad could happen. You need to be covered when it does. And this is the moment I want to step back and talk to you directly, because I think there is something important that gets lost in all of these numbers and charts and historical comparisons. None of this is about panic. I'm not telling you to panic. Panic is not a strategy. Panic is what causes people to make the worst financial decisions of their lives, selling at the exact bottom and locking in losses that can take years to recover from. Today, I have just shown you the credit spread widening, the Moody's recession model at 49%, the 100% historical accuracy of the 20-week moving average signal, the oil shock transmission into inflation, the Federal Reserve trapped between 2 bad options. None of that tells you the world is ending. What it tells you is that the balance of risks right now is different than it was 6 months ago. The probability distribution of outcomes has shifted, and when the probability distribution shifts, rational people adjust their behavior. Not dramatically, not emotionally, just thoughtfully, strategically, and with clear eyes about what they are trying to protect and why. Think about it this way. If I told you that the bridge you drive over every morning had just been flagged by engineers as having a 1 in 2 chance of structural failure within the next 12 months, you would not panic. You would not abandon your car and never drive again, but you would probably start thinking about alternative routes. You would be a little more careful. You would pay attention to updates from the engineers. You would want to understand what the specific risks were and when the most dangerous moments might be. To the posture I'm suggesting you bring to your financial life right now, not fear, not denial, attention. So let me give you the 5 things that I think every person watching this should be doing right now. Not because I am certain of what happens next. Nobody is certain. Because these are the rational responses to the specific risk environment that the data is describing right now. The first thing is to understand your actual liquidity position, not your paper wealth. Your actual liquidity. How much money do you have that you can access within 24 hours without selling something? Because in a credit crunch, in a genuine liquidity event, the people who have cash available are not just protected, they are positioned to buy assets at prices that can generate generational returns. The people who saw 2008 coming and had cash available in March 2009 when the S&P 500 hit its low made some of the greatest investment returns in modern financial history. Cash is not just a defensive position right now, it is ammunition. The high-yield savings accounts available today are paying 4 to 5% annually, which means you are getting paid to hold that ammunition while you wait. The second thing is to audit your concentration in sectors that are most vulnerable to this specific scenario. Technology stocks are the most exposed right now. They are the most expensive relative to their earnings. They are the most sensitive to higher interest rates because their valuations depend on discounting future cash flows, and they are the most exposed to the broader narrative shift from growth enthusiasm to defensive repositioning. The Nasdaq is already down more than 10% this year, due to fell 8% in a single day last week. Nvidia has been under sustained pressure. This does not mean sell everything. It means understand what you own and why you own it, and make sure the thesis for holding it still holds up in a world where rates stay higher for longer and growth slows. The third thing is to understand the opportunity in this environment. I know that sounds counterintuitive when I have spent the last 20 minutes describing a risk landscape. History is very clear about this. The sectors that do well in a stagflationary energy shock, geopolitical risk environment are not the same sectors that drove the bull market of the past 3 years. Energy companies perform well when oil is high. Defense contractors perform well when military spending is rising. Real assets, physical commodities, farmland, infrastructure, all of these tend to hold value better in inflationary environments than financial assets that are essentially promises about future cash flows. This is not a new insight. This is what happened in the 1970s. It is what happened in 2022. It is a structural rotation that occurs when the macro environment changes from the conditions that rewarded growth stocks to the conditions that reward real assets and cash-generating businesses. The fourth thing is to look at the tax opportunity embedded in this downturn. Every time markets fall significantly, there is a window for what tax professionals call a Roth conversion, which is when you take money from a traditional retirement account, which grows tax-deferred, convert it to a Roth account, which grows completely tax-free. When you do this conversion, you pay taxes on the amount you convert at its current value. If your traditional IRA was worth $500,000 in January and it has fallen to $450,000 because of this market downturn, converting a portion of it right now means you pay taxes on the lower value. So when the market eventually recovers, which it will, all of that recovery happens inside the Roth account, completely free of future taxation. This window only exists because the market is down. If you wait for the market to recover before converting, you miss the opportunity. Talk to a tax professional about whether this makes sense for your specific situation and bracket, but understand that this is one of the genuine silver linings of every market decline for people who are paying close enough attention to act while the window is open. And the fifth thing, and this is the one most people overlook, is to understand the difference between what is happening right now and what the final outcome will be. The signal I have shown you today, credit spread widening, the 20-week moving average breach, Moody's recession model at 49%, these are warning signals. They are not death sentences for the economy. Markets have absorbed oil shocks before. They have absorbed credit crunches before. They have absorbed geopolitical conflicts, rate hike cycles, and periods of stagflation before. And in every case, after the adjustment period, after the repricing, after the economy found its new equilibrium, markets recovered and moved to new highs. The question is never whether the market will eventually recover. Over any sufficiently long time horizon, it always has. The question is whether you are positioned to endure the adjustment period without being forced to make decisions from a position of desperation. The people who are forced to sell at the bottom are almost never the ones who intended to. They are the ones who ran out of cash, the ones who had too much debt at variable rates that suddenly became unmanageable. The ones who were fully concentrated in the sectors that fell the hardest, the ones who had no plan for this scenario and therefore had no rational framework for deciding what to do when it arrived. You now have a framework. Do you now understand the specific signals that are flashing and what they have meant historically? Do you know the Moody's recession model is sitting 1 percentage point away from a threshold that has never failed to predict a recession? Do you know that every U.S. recession since World War II, except one, was preceded by an oil price spike, and that we are currently experiencing one of the largest oil price shocks in history? Do you know that credit spreads are widening at their fastest pace in years, and that institutional investors are buying insurance against a credit crash at record levels? Do you know that the S&P 500 has just triggered a technical signal with a 100% historical follow-through rate? You know all of this now. What you do with it is up to you. But I will tell you what I think is most important. The next 2 weeks are a critical window. To ceasefire negotiations around the Iran conflict have a deadline. The Federal Reserve is meeting again in late April. Corporate earnings season begins, and companies will begin telling us for the first time in real numbers what this environment has actually done to their profits and their guidance for the rest of the year. The next Federal Reserve Chair decision is still unresolved, with markets divided between a more dovish appointment that would prioritize growth and a more hawkish one that would prioritize inflation control. And those two possibilities have dramatically different implications for bond yields, credit availability, and stock valuations. All of these things are going to resolve between now and the end of April. The market does not know which way they will go. Moody's model does not know. I do not know. Nobody knows. But the direction of the resolution on each of these questions will determine whether that recession model crosses 50% or retreats from it. If it crosses 50%, history says something very specific about what happens next. This is not the end. I want to be clear about that. I'm not a doomsday person. I believe in the resilience of economies and in the adaptability of human beings and institutions. The American economy has absorbed the 1973 oil embargo, the 1979 Iranian Revolution, the 2001 terrorist attacks, 2008 global financial crisis, and a once-in-a-century pandemic. It is still here. It is still the largest economy in human history. It adapts. It recovers. It finds new equilibrium. But adaptation takes time, and during that adaptation period, the people who had a plan, who had liquidity, who understood what was happening and why, were able to do something that most investors never get the chance to do. They were able to look at assets that were priced for catastrophe and buy them at prices that made them wealthy over the following decade. It is the opportunity hidden inside the signal I have just shown you, not panic. Not catastrophizing, not selling everything and putting it under a mattress. Clear-eyed, rational, historically informed positioning for what the data is actually telling you is a genuinely elevated risk environment. The signal just fired. It has a 100% track record since 2018. Moody's recession model is 1 point away from the line it has never crossed without a recession following. Credit spreads are widening at pace. The oil shock is real. The Fed is trapped. In the 2-week window between right now and late April is when the next chapter of this story gets written. You have been watching the buildup. This is where things move fast. This is where preparation separates the people who come through this stronger from the people who come through it damaged. Build your cash reserves. Audit your concentration risk. Look at the tax opportunity in the downturn. Understand the rotation towards sectors that benefit from this environment. In whatever you do, do not let the noise of the daily headlines make you forget the signal underneath all of it. Because that signal, the one that almost nobody was talking about, the one hiding in the credit markets and the recession models and the moving averages and the institutional hedge data, that signal is what I showed you today. And now that you have seen it, you cannot unsee it. The only question left is whether you act before the market does, or whether you wait until the market is already telling you something you could have known weeks earlier. To people who prepared for 2008 by understanding the signals in the credit market, not the ones who waited for the stock market to scream at them. Those people did not just survive what came next. They came out the other side in the strongest financial position of their lives. Because preparation is not just protection. Preparation is opportunity. And the window for that opportunity is open right now, Today, this week, before what I have just shown you finishes playing out. Do not close this video and go back to whatever you were doing before without at least taking one step, one concrete action toward making sure that whatever happens in the next 30 days, you are not caught flat-footed. If this analysis was valuable to you, I want you to do 3 things right now. Subscribe to this channel because I track these signals in real time and I translate what the professional money is doing into language that actually makes sense for the rest of us. Hit the notification bell so you do not miss the next update because this story is moving fast and the next development could come any day. Share this video with someone you care about who has money in the market right now because most people are not going to hear this anywhere else. You're going to hear about resilience and buying opportunities and long-term fundamentals. They are not going to hear about the 49% recession model that is 1 point away from the line it has never crossed. They're not going to hear about the record institutional hedging in the credit market. They're not going to hear about the 100% technical signal that just fired in the S&P 500. But you heard it. And now you can decide what to do with it. That is the difference between being positioned and being blindsided. Make your choice before the market makes it for you.